Brand the Mortgage Man here, and if you currently own a home, I hope you're paying attention. Do you currently have a significant amount of equity but aren't sure what the best way to access it is? I've helped more than 10,000 home buyers over my 20-plus year career, putting me in the top 1% of loan originators nationwide. It's with this experience, I'm gonna share what I consider to be the 3 best methods to access your home's equity. In this video, I'll explain the differences between cash out refinances, home equity lines of credit, and something that's become a little more popular, home equity agreements, in order to help you make an informed decision when it comes to your own scenario. So let's start off with cash out refinances. So a cash out refinance is when you pay off your existing mortgage with a new mortgage that's equal to a greater amount than you previously owned. If you owed $200,000 on your home and you want to do a cash out refinance to pull out some equity, your new loan amount would be greater than $200,000. Maybe it's $300,000. And what happens is you receive that difference between what you owed previously and what the new loan amount is as cash in your hand. That's a cash out refinance. Now, this also applies in situations where you might own your home free and clear. So maybe you don't have a mortgage on your home, but you want to pull out equity and you're going to have a new mortgage. Well, that's also considered a cash out refinance, even though you're not paying off an existing mortgage because you don't have one on the property. So some of the pros of a cash out refinance are, for one, you're receiving the cash in hand, right? That goes without saying. You're receiving the actual cash. You can do whatever you choose or want to do with that money. One of the biggest things or most common things that people do with a cash out refinance is they pay off other debt other than their mortgage. So one of the nice things about owning a home and having equity in your home is that that money can be used to pay things off. So when you pull cash out in the form of a cash out refinance, rather than physically receiving that cash in hand, in some cases, we have clients who actually use that to pay off credit card debt or other types of debt with higher interest rates at the time of closing. So you might have credit cards, as I said. You might have installment loans. Debts that have high credit. You might owe taxes. It can be used for multiple things, but it doesn't just have to be used to pay off your existing mortgage. That would be part of it, but you'd also go ahead and pay off these other things. And the resulting payments or overall payment is going to be lower when you do that. Now, a downside to doing a cash out refinance is, for one, you're utilizing equity or using equity from your home, right? You're gonna have less equity because you're now going and pulling that out of your property. You also have to make a payment on the entire balance of the new loan amount once you receive that. And I'll compare this to other options and why that's not as advantageous as maybe some alternatives like a home equity line, as I mentioned earlier on. But you have to pay on it immediately, right? So that can be considered a con. And now you're gonna have a higher balance on your property, leaving less equity when you eventually go and sell the property. So let me give you a real life example of how a cash out refinance works. So I recently had a client who reached out to me. They have a 3% interest rate on their first mortgage, which is extremely low. So naturally, you might say to yourself, why would you ever pay off a 3% interest rate and get a new loan at a 7% rate, which is current market rate? Well, they had a substantial amount of credit card debt, right? And those credit cards, average interest rate that they're paying on those, or APR, is 22%. And if they're only making the minimum payments, as they were in this case, it's going to take them over 25 years to pay those credit card balances off. So what we did is we took equity from their home. We paid off all of the credit card balances using the new mortgage, and their overall expenses went down by $2,000 per month. $2,000, right? So their mortgage payment increased. So if we looked at what their existing mortgage payment was using a 3% interest rate on the lower loan balance compared to what their new mortgage payment is, just the mortgage payment, that payment increased. But when you're doing a cash out refinance, like in this example, and you're paying off debt, what you really need to look at are the overall debts that are being paid off as far as the monthly payments are concerned and what the new monthly payment will be. Because now, in this case, it went from having 11 payments, it was 10 credit cards and the mortgage, so 11 separate payments, to one payment. That's now $2,000 less than what was being paid on a monthly basis for those same debts. Think about it, $2,000, $24,000 a year. That is substantial. Now, not everyone's in a position where they have that much debt that needs to be paid off, but there are a lot of people that have a lot of debt. And the benefit of being a homeowner and having equity, especially if you bought within the last 3-4 years, your home value's gone up substantially. You can utilize that equity in the way that my client has. Now, that's how a cash out refinance works, and that's how it worked in real life for this scenario. Let's compare that to an alternative, right? An alternative to doing a cash out refinance is a home equity line of credit. A home equity line of credit works the same way as far as using your home's equity. However, it's a revolving line of credit. It's not just receiving cash in hand and receiving a new first mortgage, right? We wouldn't be touching your first mortgage when you're getting a home equity line of credit. Your first mortgage would be the same, and you'd be adding a second loan to your property, which is the home equity line of credit. It goes in second lien position. So now you have your first mortgage balance and your home equity line balance. Now, a huge benefit to a home equity line is that you're only going to pay on what you're using. So let's just say you took out a home equity line for $100,000, but you didn't even need to use any of that money. You wanted to know you had it available, but you didn't necessarily need to use any of it immediately. You wanted it for future use, for an emergency. Well, if your balance is zero on the home equity line, although your limit is $100,000 in this example, your payment is zero and you're paying no interest, right? It's like a credit card. You only pay on your credit cards or pay interest on your credit card debt if you have a balance on those credit cards. An equity line works the same way. You only pay on what you're using. Now, a negative about a home equity line is that because it's in second lien position, the rate is much higher than what you would receive on a first mortgage. So we said that my client got a 7% when they did a cash out refinance within the last couple of weeks. But a home equity line is based on prime rate. Prime rate's currently 8.5, but you're not going to get prime rate typically. You're going to get prime rate plus some sort of margin on top of that. So what we're seeing as the average interest rate for home equity lines right now is about 10.5%. So think you are going to be getting a higher interest rate, which is still lower than what some of your credit cards might be, because you can still use this in the same way you did a cash out refinance, right? You can still pay off debts and utilizing your home equity line, and then you'll pay on the balance that's being used. But just keep in mind, it's going to have a higher interest rate, and that rate is variable. It's not fixed. Now, it's variable based on prime rate. As I mentioned, prime rate does not move month to month. Whenever you hear about the Federal Reserve meeting and talking about raising rates or lowering rates, that's the Fed funds rate, which actually has a direct impact on what prime rate is doing. So if the Fed funds rate increases, prime rate increases. Fed funds rate decreases, which is expected to do later this year, well, then the prime rate would decrease, typically by 0.25% or 0.5%, and you'd see a reduction in your payment. Now, home equity lines also allow you to pay just the interest if you want to, meaning that you don't have to pay the balance down. So in this example, if you took $100,000 out, and let's say you borrowed $50,000 of that or used $50,000 of that, you only have to pay interest on that $50,000 if you want to. And the way home equity lines work is you typically have 10 years where you can pay interest only, and you can actually keep withdrawing money from that equity line. And then the remaining 20 years, because it's in most cases 30 years, you'd actually have to start paying back that balance. You can no longer pull money from it, right? So you want to keep that in mind when you're utilizing a home equity line of credit. Now, what we usually use home equity lines for is for scenarios where someone has a substantial amount of equity in their property and maybe they want to go buy an investment property, or they want to free up money to use toward a down payment on a new primary residence, right? In those cases, if you don't have the cash available, you have the equity in your home, we can do a home equity line of credit that works the same way as having cash, because you can use that to put a down payment on an investment property, a second home, a new primary residence, whatever your plan is. Because you can use secured funds, because these would be attached to a property. It's okay to use those toward the purchase of other real estate, right? You can't use a loan toward the purchase of real estate unless it's secured. So because this is secured against the property, it can be used toward the purchase of real estate. That's the most common way we're seeing home equity lines used. We're also seeing them in cases, like I was mentioning, where maybe someone doesn't want to touch their first mortgage because the rate is so low. Maybe they got it in 2020 through 2021 when rates were in the 2s and 3s. They don't want to touch that. They don't need to pay any debt off immediately, but they do want to have access to those funds. A home equity line is definitely a great option in those cases. Now, the last option, or of the three methods that I would say that you'd want to potentially look at, is a home equity agreement. Now, just to be clear, this is a last resort, because a home equity agreement is a financial agreement where you're selling shares of your home's equity to an investor in exchange for a lump sum of cash up front. And the way it works is you're going to pay some sort of fee up front to get these funds. And then when you eventually sell your property, depending on if that's going to be 1 year, 2 year, 3 year, 4 year, 5 year, 10 years down the line, whatever it is, you've agreed to pay the investor that you receive these funds from a portion of your proceeds on that sale. So this is going to be the most expensive option when it comes to pulling equity from your property. Now, why would someone ever go this route, right? If it's the most expensive and you have a cash out refinance option, you have a home equity line option, why wouldn't you use those? Well, like I said, this is a last resort because for this type of loan, you don't need to verify income, you don't need to verify credit, you don't need to make monthly payments, right? You're going to receive the cash in hand. So that's pretty advantageous, right? The cons, of course, are you're giving up a large portion of your home's equity to this investor when you eventually sell, and you're paying a large fee up front as well to do that. But if you're a person that's in a scenario where you can't even qualify for a cash out refinance or a home equity line, because keep in mind, you still have to qualify for those. You have to be able to show your employment. You have to be able to show your income. Your credit has to meet the minimum requirements to qualify for those loans. It's not like someone's just going to give you the money just because you have equity in your home. But with a home equity agreement, that's exactly what's happening. Someone is agreeing to give you the equity in the form of cash in your hand just because you have equity in your home. But for that, you're going to pay a large fee. I actually have a client that we helped out with a purchase last year, and their property value jumped up substantially. At the time that they bought the home, they had a large amount of money to put down, and they had to put a large down payment because their credit score was putting them in a position where they could not get a loan with less than 40% down on the property, which is a substantial down payment. Problem is, that money is now tied up in the property. And when we looked at options for pulling cash out or a home equity line, unfortunately, their credit score was still not where it needed to be to qualify. And they recently sold the business that we had used to qualify them for the mortgage. So now they had no source of income that was usable, and their credit score didn't meet the minimum requirements for a home equity line of credit or to do a cash out refinance. So their only option was to do a home equity agreement, which is something they did because they were starting a new business. They wanted to free up some of that equity they had in their property, use that toward building their business. In their case, it made sense to do it because they were utilizing those funds to generate more income for themselves. So although it was going to cost more money in the long run versus the other options, which they didn't qualify for, they were able to use this to generate money to build their new business, which in the long run is going to work to their advantage. So you want to consider your own scenario before you go in and determine which of these is going to be best for you. And of course, naturally, you need to go with whatever you qualify for, right? So by understanding these three methods of accessing your home's equity, you'll be ready to make informed decisions and achieve your goals. If you find the information helpful, make sure to subscribe to my channel so you can continue educating yourself on real estate and mortgages, and make sure to leave a comment below if you have questions about your own scenario. I reply to 100% of the comments left on my videos.